You did everything right. You read the advice, you listened to the guy in the suit on YouTube, you opened a saving account and you dumped 3 to 6 months of expenses in there like a responsible adult. And now that money is just sitting there, slowly, quietly dying. Welcome to the Top Finance, the financial wasteland broadcast where we don't sell you dreams, we roast the ones you already bought. Let's talk about inflation, not the buzzword, the actual monster. Right now a standard saving account pays you somewhere between 0.01% and 0.5% interest. That's not a typo, that's your bank's way of saying thanks for the free loan, buddy. Meanwhile, inflation, even in a calm year, eats through 3 to 4% of your money's value. So you have 10,000 sitting in your emergency fund. Congratulations, next year it buys you 9,600 worth of stuff. The year after, 9,200. You didn't spend a cent, you didn't do anything wrong, and yet your money quietly got mugged while you slept. That's not safety, that's a slow bleed. Here's the thing, the 3 to 6 months emergency fund in your saving account rule isn't evil. It was invented for a real reason. Back when banks were collapsing, people were stuffing cash in mattresses and the stock market was a casino with worse odds. Keeping liquid cash somewhere boring made sense. But that was a different economy, a different interest rate environment, a different world. Today your bank takes your emergency fund, lends it out at 7, 8, 20% on a credit cards and hands you back 0.2 like you should be grateful. You're not being protected, you're being used as a free float for someone else's profit. And the financial advice industry, the gurus, the influencers, the guy with the whiteboards keeps repeating the same rule because it's a safe advice. It can't get them sued, it sounds responsible, and it never actually challenge the system that pays them. Okay, so the emergency fund advice is broken. Does that mean you shouldn't have one? No, you absolutely should, don't be an idiot. But when you park it matters enormously. Option 1 at the bare minimum is a high yield saving accounts. HYSAs are still saving accounts, but instead of 0.2% you're looking at 4 to 5% in a decent rate environment. That's still not beating inflation forever, but it stopped the massive bleeding. It's the same emergency fund, just not in a financial coma. Option 2, and this is where it gets more interesting, is a money market fund. Not a money market account at your bank, a money market fund through a brokerage. These invest in short-term government debt, they're extremely low risk and they've been paying 4 to 5% as well. Your money stays accessible, it just works slightly harder. Option 3, and only if you're disciplined, is keeping a smaller liquid emergency fund, say 1 month of expenses in cash, and putting the rest in very conservative short-term bond, ETF or treasury bills. You take on a tiny bit of volatility, but your money is actually fighting inflation instead of surrendering it to it. None of these are get-rich schemes, none of these are risky, they're just not stupid. But here's the darker truth underneath all of it. The emergency fund conversation is really about something else entirely. Most people don't have an emergency fund problem, they have an income problem, a spending structure problem, I make decent money but I have no idea where it goes problem. An emergency fund sitting in the wrong account is annoying, not having one at all because you're living paycheck to paycheck on a salary that should be enough. That's the real wasteland. The financial industry loves to talk about optimizing your saving rates, your asset allocation, your expense ratio, because these are the comfortable conversation. They don't love talking about the fact that wages have been flat in real terms for 45 years while housing, healthcare and education costs have tripled. They don't love talking about the fact that the entire system is designed to keep you slightly too busy, slightly too stressed, and slightly too confused to ask the bigger questions. Your emergency fund losing 3% a year to inflation is a symptom. The disease is a financial system that treats your stability as someone else's profit margin. So what do? Step 1. Move your emergency fund out of a garbage tier saving account. Today, not next week, today. Open a high yield saving account or a money market fund and move it. Step 2. Figure out if your emergency fund is actually the right size or is just a security blanket that's grown too big while your investments sit empty. Step 3. Start asking harder questions. Not just where do I put my money, but why is this system set up to make that question so confusing in the first place? That's what we do here. This is Tough Finance, the only financial channel that is tough enough to tell you the truth. If this made you uncomfortable, good. Subscribe. There are more uncomfortable truths coming. And if your emergency fund is still at the 0.2% saving account, fix it or the wasteland wins.